Okay. Alrighty. Well, the next few bits aren't going to be quite that heavy. Now let's go with the person that most people associate with deliberately talking about instability in capitalism. In fact, there's actually a Schumpeter paper called precisely that. This is Joseph Schumpeter, who's, I didn't realise his calibre as a thinker until very late in my economic career. I only started reading about 15 years ago, which I think was a big mistake by me. So Stan asked a moment ago who would I recommend for reading in this area, and what would I recommend? And the best book, the briefest book that gives the best explanation of his theory is called The Theory of Capitalist Development. I'm not sure if it's a free book, but I'm certain you can. I think it only costs about $10 to buy it through Amazon.
There is a Spanish translation of that.
Is there?
Published by Fondo de Cultura Económica.
Excellent, that's fantastic.
Yeah, right.
Yeah. Now, he argued that change and instability complemented the static analysis that neoclassicals did. He was a great fan of Walras, and he thought that Walras captured the actual process of reaching equilibrium in capitalism, which we now know is wrong. But he took that as for granted as the basis for reaching equilibrium. But he said there's also processes of growth and disturbance going along at the same time. And he thought you could separate the two. He thought you could describe processes towards equilibrium in one component of the theory, so it was still valid to do Walras, but you also have to have something else which breaks that stability. Now, I think you've got to integrate the two, so I differ with Schumpeter on that particular point. You have to have a completely dynamic theory all the way through, rather than having a static theory of reaching equilibrium prices and a dynamic theory of disturbing those prices. But that was his vision. But he saw instability as both fundamental to capitalism and a good thing. And normally when we talk about instability, it's automatically got a negative connotation. But he said, no, that instability is what enables capitalism to give its growth and change. And no other society had that before capitalism. And it also explains why capitalism is cyclical. So, in contrast to believing in instability and equilibrium, he says the system in which we're based upon is inherently unstable. And when you look at this and you think, how on earth can people get obsessed with the idea of equilibrium when they're looking at capitalism, when all you have to do is just sit back and say, what's been history? He says, there's no such thing as a stable social system. All social systems have changed. Most have broken down and turned into another social system. He said, any system transforms itself simply by its mere working, and if history teaches us nothing else, it teaches that. So simply and profoundly put. I think you can also see the extent to which there's a very strong similarity with Marx's thought on this front. And Joan Robinson once described Schumpeter as Marx with the adjectives changed. So there is a strong commonality here. So transformational growth is the essence of what Schumpeter was talking about. It isn't just a case of expanding the volume of commodities, it's changing the nature as well. So growth is not just a quantitative thing, it's also qualitative. And that's where the idea of creative destruction comes from as well. So that growth leads to social and technological change. And that progress itself destroys previous technologies and previous social relations as well. That's just the essence of seeing change as being the essence of capitalism and society in general. So again, there's a dialectical vision there, not spelled out as explicitly as with Marx, but prosperity contains the seeds of its own destruction. So he said when a new thing, for example, when this happens, when you have a new thing being built, so let's take example, I think the best example right now is Tesla, one of my favourite companies and certainly one of my favourite entrepreneur, Elon Musk, building electronic cars and a whole range of other innovative technologies. While that's being built, there's an industry around expanding that machinery, building the technology. The engineers are going out and spending the incomes they're earning, etc., etc. There's an expansion going on. Supernormal spending. You said, but once that's gone on for a while, as those new products start turning up in the market, if that technology is genuinely disruptive and replaces the internal combustion engine, then what happens to Ford and General Motors and Toyota, etc., etc.? So you get an expansion when you're building the new technology, and when the products turn up on the market, you can get a contraction. There's two phases to this. So he said that's a an essential thing of capitalism is this cyclical behaviour and the fact that expectations will be out of phase with reality itself. So they said, if you see value and profiting increasing, and that can be because you see a new technology you want to become part of, so everybody tries to build electric cars, or even go off and supply sushi to the people making the electric cars. It isn't just in the one industry that it stays there. You're going to project that rate of growth into the future. You're going to invest more. And you'll enter into commitments which turned out to be ill-conceived. So rather than having rational expectations that neoclassicals call their fantasy vision of how we form expectations, this is saying projecting current conditions forward and then being disappointed is a natural part of capitalism, and that will give you cycles. So he had a conventional vision of neoclassical economics about utility, maximising individuals, and a marginal productivity theory of income distribution, and Say's law applying when you're in equilibrium. So that is that in every economic system there'll be a demand somewhere awaiting every supply, and nowhere in the system are there commodities without complements. So sellers of all commodities appear again as buyers in sufficient quantity. They'll be when you're in equilibrium, all this happens. But he said there are no profits in that situation. If you're actually in static equilibrium, the price of all products is equal to the price of the services you buy to produce them, and therefore net profit can't exist. Okay? Gross profit can. Your profit rate can be equal to the rate of interest. But why be a capitalist if all you get is a rate of interest? And therefore in that situation as well, money doesn't really matter. You said money is just a cloak over economic things. Nothing essential is missed by abstracting from money. And he used money as a gold. He said you can treat money as a commodity. That's all you need to do. He said profit actually comes from discontinuity and disequilibrium. And you can't explain that using static thinking. He said static thinking can't explain where productive revolutions come from. It can only investigate the new equilibrium after you've had that disruption. So even though he's starting from saying we can accept Volra's vision of equilibrium as how the economy functions when it heads towards that destination, which we know now is mathematically wrong, he said even given that, disruption and change really describe the actual dynamics of capitalism. And to do that, you have to have an evolutionary approach. Now, interestingly enough, when Schumpeter wrote his theories, at this stage, Darwin was being criticised in the literature quite a bit, as it turned out wrongly. But when he wrote, he's saying, well, the evolutionary idea is now discredited in our field, meaning economics in particular. But people were doing various attempts to handle evolutionary theory, and he was saying, well, I'm going to be using evolutionary theory, but different to what you think evolutionary theory is. As I said, once you get away from those conflicts, there are still two things that happen. First of all, historical change is obvious, and secondly, these changes are not a circular process. They don't go back to where they started from, nor can you describe them as just wobbles about an equilibrium point. They are transformational change. He said what actually happens in capitalism is spontaneous and discontinuous change, disturbing that equilibrium, which then creates a new equilibrium, which you may or may not tend towards. That's the essence. Am I going too fast there, by the way? Yeah. Yeah?
The last point you I mean, from that perspective, if it's just like a brutal change from one equilibrium situation to the other, then a static view could bring some reasonable insights. I mean, if you just consider that stable equilibrium and then a sharp change and then another equilibrium, so then a model where you would use only static analysis. I mean, it could work.
It could work if you were willing, if you wanted to ignore the transformational side, because the static equilibrium thing wouldn't explain where innovation comes from. And so you'd be talking about a world where you had, many more horses than we had back in the 19th century. You couldn't explain why we actually now have trains or cars and so on. So it does in a way, and that is partly what a lot of neoclassicals do, and even non-neoclassical, like for example the Sraffian school, which Ian Steedman is part of, and they would say that statics is where all the dynamic forces have worked their way through. So if Schumpeter was right that Walras got it right for equilibrium, then you could use with the argument you're using. In fact, we know, neoclassical economists don't accept that we know, but we do know that Walrasian equilibrium is unstable. So you won't even get there. Okay, so and if I had a chance to teach a long course, I'd take you through the Sonnenschein-Mantel-de-Boer theorems that prove that. So it doesn't work even, it could work if Walras were right, but Walras was wrong. So he said you have to focus on the sources of change and look at that process. And of course, once you do that, it's like a static equilibrium view. Imagine trying to apply that to actual evolution. We couldn't explain why we are not dinosaurs. So, yeah.
But what I mean is that, like, the source of change,
Yeah.
the dynamic of change could be like completely negligible for a good while, and then just explode at some point and creates the transformation.
Well, but in fact, what Schumpeter argues is twofold. First of all, it's always going on, but it goes on in surges and cycles.
In what?
It surges and cycles, okay? And therefore, that focus you can't explain from an equilibrium point of view. He has a wonderful phrase at one stage where he says that the difference between equilibrium and innovation is it's a similar difference to walking down a road versus making one. Intriguing little analogy there. So he says development occurs when you have an entrepreneur who wants to make profit and does it in several ways. You can introduce a new good, so that's the electronic car as an example of that, or introduce a new method of production. The classic in terms of our industrialisation was going from I've forgotten the actual names now of the processes, but the iron ore processes for making steel, going to the Bessemer process was a major innovation at that level. Equally, like 3D printing is a new innovation we're seeing in production right now, which may have transformational impacts. Open up a new market, so China becomes available or the West becomes available to China. Or introduce a new source of supply, which is what you're potentially doing with that oil. Or reorganisation. I think that's actually much less important, or changing how an industry is organised. Perhaps Walmart is a classic example of reorganising retail. Okay. And he says, first of all, to talk about how this happens, he does a number of interesting things at a verbal level. And I have to say that Schumpeter is the only economist I've ever read who has a completely verbal logic and never makes a mistake in working that logic through. Marx made mistakes, Keynes made mistakes. Schumpeter alone, I think, has a completely coherent theory where you can't say he made a logical error by going from point A to point B. So he starts from an assumption that entrepreneurs are not involved in existing firms. Now, of course, a lot of them are. So to say entrepreneurs are only people who are not in existing firms makes it harder to explain how do entrepreneurs actually affect production. So rather than being a simplifying assumption, as neoclassicals often talk about assumptions, it makes it more difficult to explain your point. And that, I think, is the sort of assumption that I'm happy to see someone make, because it makes it more difficult, more challenging to explain why their idea matters. So he's assuming entrepreneurs are not inside existing firms. And he also assumes that the economy is fully employed. So rather than having idle resources you can bring in, you've got to pull resources away from existing uses where they're already getting the proper wage, the proper payment. That's difficult. That's making his position harder to explain. Rather than saying, let's assume a can opener, which is the way you can paraphrase most neoclassical assumptions. Have you heard that joke? Yeah. You haven't heard it. Well, the rest of you got to put up with it. A physicist, a chemist, and an economist get wrecked on a desert island. And from the boat washes ashore a container just full of baked beans, nothing else. So the physicist says, well, there's plenty of palm fronds out here. Put them in the right place so I can get the sun to cause them to burn, and I can make the cans explode. And the chemist says that. The physicist said, well, if you do that, I can calculate the trajectory of each of the beans so we can catch them and eat them. And the economist says, oh, boys, you're being far too complicated. Let's assume we have a can opener. Okay. Now, so if entrepreneurs aren't in existing firms, and they don't have free resources to make use of, they've got to have money to get hold of those resources. So they have to get credit. And therefore what they've got to do is approach a bank. And he calls bankers the capitalists par excellence. Effectively he's describing bankers as venture capitalists. They're giving money, lending to people, some of whom will come up with ideas which are disruptive and profitable, others which will lose money. This is actually the role bankers should have, rather than the role they do have. Okay? I think unfortunately, banks are nowhere near as good as Schumpeter talks about them being. But he then sees the entrepreneur, the individual coming up with this new idea, as the organ of change. And he says, carrying out new combinations he calls enterprise. People who do that we call entrepreneurs. Of course, there are managers as well, managing current systems. Very, very different to entrepreneurs. So he said net profit comes out from this development. By coming up with a new product, by getting the money to develop that new product, by producing it and then selling it in society, he makes a profit. And he also brings about new commodities. But how does he make that profit? Well, he said, first of all, I'm going over that section too quickly, and I think I better reorganise that for a future lecture. I've missed a few points there. Let's see. Okay. He has the entrepreneur borrowing money and then repaying it and making a profit. So later on in the slides I'll explain that. I think I put this in a bad structure here. I'll fix this up before I put it onto the website. Let's see. But he says money is essential, because if entrepreneurs don't get money, they can't innovate. So he sees the creation of new money as an essential part of capitalism. And he says, therefore, demand in the economy is not just demand from the existing turnover of goods, what he called the circular flow. He said in real life, total credit must be greater than it can be coming only from the turnover of existing goods, which is something I have been arguing in recent years, and I'll go into that in the fourth and fifth lectures. So he's saying what banking is doing is actually creating new money, giving it to entrepreneurs and adding to demand. The demand wouldn't be there except for the coexistence of entrepreneurs who borrow and banks who lend, creating new demand above and beyond what comes out of the circular flow. So there's disruption of the equilibrium, leading to a net profit for the capitalist who innovates, or the entrepreneur. There's net credit, expanding the money supply, and ultimately he thought he'd get back to a new equilibrium. You see, once that happens, once the new products have turned up, then you get a complete reorganisation of industry. Old products become obsolete. Workers might get dismissed from those old factories. The classic instance, of course, at the moment for us would be, I mentioned that yesterday, cassette recorders. Factories that made cassette recorders would have sacked all their workers. Nobody buys cassettes anymore. MP3 players killed them. Okay. Electric cars may do the same to internal combustion engines. So there's a disruptive level when the new products turn up on the market. And he then says a new equilibrium will come out of that, and therefore the surplus disappears, and then you go on to the next stage of innovation. Now, I don't believe we ever reach that equilibrium. It's not stable to begin with. But that process of change that he's talking about is a genuine process of change. And they've got a surplus that's come out of that. And it comes in cycles, because he said the new combinations don't just happen in random, they tend to cluster. And the reason for this, there are three reasons. First of all, they don't go to existing firms. Now that's actually wrong, okay, but they compete with them. That is true. So a new innovation comes along. If Sony, for example, which is an existing firm, came up with the Walkman, which was the first major disruption for music. That came out of an existing firm, but it did compete with pre-existing products. And then he says, demand occurs en masse. Once you have injected this new money into the economy, the entrepreneurs who borrowed that money and their workers are now spending that money, you've therefore caused a secondary boom which goes beyond your own industry. So the classic example, of course, is industries like sushi manufacturers who pop up around firms that are innovating firms. The workers buy there, sushi demand expands, So the wealth that comes out of the product of the new innovation of the new technology affects existing industries as well. And you then have errors turning up as well. You put too much money in. There will always be errors, mistakes in innovation. So there will be multiple firms that try an innovation. Only one of them is going to succeed. For example, we all know of Apple and Microsoft. There's two major successful firms in the computer industry. If I had to pick the firm which would win in innovation back in those early days for computer technology, I would have gone with a company called Digital Research. Anybody heard of Digital Research? Okay. They introduced the first computer operating system for PCs called CP/M. It was far superior to what eventually became MS-DOS. The reason that CP/M failed and MS-DOS succeeded was that Digital Research, the price they wanted to charge IBM for building the operating system for the IBM PC was too high for IBM's liking. So they went with a cheap bid from a guy called Bill Gates. So he said, why isn't that a continuous stream? Why does it come in clusters? And he says, because first of all, if you have one entrepreneur who succeeds, that will drag others into the same field. And it isn't necessarily the first entrepreneur who wins. Quite frequently, the early mover will fail. Okay? You'll have an innovation, for example, who invented the graphical user interface, the mouse, and pointing and clicking? Which company? Anybody heard of Xerox? Okay. Xerox and Palo Alto were the ones who invented the idea which Steve Jobs and co. literally stole. And Steve Jobs actually said that himself, to build the Macintosh. So the first innovator doesn't necessarily get the surpluses. Others turn up there. You said, so every boom also starts in one industry, but that then enables booms to occur not just where you started, but in other industries as well. So for example, taking the electric car example, that will be causing a boom in manufacturing of batteries. Okay, so you get a feed-through effect. One industry booming causes secondary booms in other factories. So you have an effect well beyond your initial starting point. But a boom ultimately leads to a bust, because when you're financing this new innovation, you expand net credit and general activity increases and wages go up as well. But once the innovation is produced, you start undercutting existing enterprises and you repay the credit. So the money you've created by borrowing it gets taken out of circulation, destroyed, for want of a better word, and the credit system contracts. So those two forces both deflate prices and potentially cause financial distress. And he then says this process explains the length of the boom, the cycle we go through. The appearance of a new product causes prices to fall, which terminates the boom, can lead to a crisis, must lead to what he calls a depression. But what he calls a depression, we would now call a recession. And then the process starts again. So you have a positive vision of what he calls recessions. Again, I was sceptical about this part of Schumpeter when I first read it. But I was reading Schumpeter during the dot-com bubble. Now, if you look at the dot-com bubble, what happened during that period was an incredible excess investment in optical fibre technology in particular. Masses and masses of cable were laid all across America that were never turned on, because to use that cable, you had to have a laser at one end and a receiver at the other. And a huge amount of that cable is what they call dark cable, because when the boom collapsed, it simply wasn't worthwhile to connect all that cable. But of course, since the cable existed in the recession that followed, a mild recession as it happens, we started to use the internet in a much more pervasive way, and that technology became available. So he said often the technology becomes adopted during the recession that follows it. But he wasn't thinking about something like the Great Depression, even though his major book was published in 1934. Not his major, but one that I regard as most useful. Which is where we've got to talk to another innovator, who's Irving Fisher. And I mentioned Irving a bit. That's Irving. He has a sort of ethereal look to him, doesn't he? Interesting character. And in some ways he was the Paul Krugman of his time, but I think he did rather better than Paul has done so far, because he actually really changed the basis of his thinking. See, he was a famous neoclassical economist, and the reason he was famous, he developed in the early 1900s, he developed the precursor of the efficient markets hypothesis, an argument for how he could have a supply and demand theory of finance. And he was independently wealthy because he invented what was called the Rolodex. Anybody heard of that? Think of a mechanical version of an iPad. It was a circular device which you could put cards into, ranked A to Z and 1 to 9, which you'd have people's information on. Early retrieval system. So he invented that as a tinkerer. He then sold it to the Rand Corporation and got paid in money and shares, and then invested in the stock market. He was an entrepreneur. Literally was an entrepreneur. Okay? Unlike most economists, he actually invented something. He was also a columnist on the New York Times. I think it was, New York Times it was. And he was a stock market bull. He believed the market, even though people were saying it must be overvalued. At the time he said, no, it's reflecting our future growth prospects. And he was heavily invested on margin, massive margin loans. Back in those days, you could put down $100,000 and buy $1 million worth of shares. And if the shares went up by 10%, you doubled your money. Okay? But if the shares went down by 10%, you had to put in another $100,000. If you didn't have it, you were wiped out. Okay? That was the situation he was in. So he believed in his financial positions, he believed in his equilibrium theory of finance as well, and two assumptions he had in making that theory to get a supply and demand theory of finance were the market has to be cleared, and notice this, and cleared with respect to every interval of time. So he's projecting equilibrium through time here because when you work in thinking about the market for fizzy gas, gassy water, if I pay for it, I get it straight away, I consume on the spot. There's no time issue necessarily involved in my consumption. But if you take out a loan, you're promising to pay money. You get money now in return for a promise to pay money over a period of time. So you necessarily have a time dimension to this market. That's his first assumption. His second is wonderful. Debts must be paid. Nobody goes bankrupt. Unfortunately, including himself. Well, as a newspaper columnist, on October 16, 1929, he wrote this infamous statement in the New York Times. Stock prices have reached what looks like a permanently high plateau. He said, I don't think there will ever be a 50 or 60 point break below present levels, such as Mr. Babson, a bear commentator had predicted. He said, I expect to see the stock market a good deal higher than it is today within a few months. And what then happened less than a week later, it lost 10% in a single day. And 4 years later, it was down to 1/6 of its peak and he'd lost $10 million, which of course he didn't have. A large part of that was margin loans. So he was sent bankrupt. I've just actually found, this is the original newspaper article I've embedded. You probably can't read it there properly, but that's being interviewed, and he says, Yale economist tells purchasing agents increased earnings justify rise, etc., etc. And stock prices have reached what looks like a permanently high plateau. Irving Fisher, Yale economist, told members of the Purchasing Agents Association last night, etc., etc. Okay? Well, you can imagine what happened to his reputation when a week later, so profoundly wrong. And if you look at the scale of how wrong he was, this is a chart of the Dow Jones from 1914 to 2010, and that little excerpt down there, that's the decline. It peaked at 382 in about September sometime, and by the time it stopped its fall in 1932, it was below 42 points. It took less than 3 years for that to happen. But if you then see how long did it take to get back to the previous level, over a quarter of a century. But notice all the rallies that occurred there. You might think, oh, the worst is over. Well, goodbye for that one. And then another rally, and goodbye for that one. And on you go all the way down. So it took 3 years before that process was over. And by the final end of it, it was down 89% from its peak. So it's far more severe than what we've been through. And even if you look at the index alone and think how long did it take to recover, that was 25 years. But of course the index is a collection of companies priced today versus another set of companies 25 years later. They're not the same companies. So if you had invested in the Dow Jones in 1929, it would have taken you probably till about 1980 to get your money back, because a lot of those companies failed during the Great Depression. and were replaced later on. So he went from being a sage to a laughing stock. But in the aftermath, he developed an alternative theory, what he called the debt deflation theory of Great Depressions. And he rejected those two conditions because he said he assumed equilibrium. But again, as I've taken you through beforehand, any real-world equilibrium will be very short because you'll get new disturbances, even if you're in equilibrium. So it'll be above or below that ideal. So disequilibrium is the rule. And you have to have a disequilibrium theory to explain how the economy operates. And he said the key elements that are going to be in disequilibrium that cause crises like the Great Depression are debt and prices. And he says those are the two dominant factors. Over-indebtedness to begin with, and deflation shortly afterwards. And he said overinvestment and overspeculation are often important, but they have far less serious consequences where they're not conducted with borrowed money. So he said over-indebtedness and overinvestment lead to overspeculation, same with overconfidence, etc., etc. I love this phrase coming up because it's really said from the heart. Because this man, he didn't actually go bankrupt because his wife's sister was incredibly wealthy, and she paid his debts and then re-forgave those debts, his debts to her on her deathbed. So he never actually went technically bankrupt, but he certainly was effectively bankrupt. He said, I fancy that overconfidence seldom does any great harm, except when, as, and if it beguiles its victims into debt. That is said from the heart. So he said, when you have overconfidence leading you to get too much in debt, you then get a chain reaction. Too much debt, you're forced to liquidate, distress selling. Because you reduce your prices, everybody else does as well. People are paying off their loans, so the deposit currency contracts, the amount of money in circulation declines, which again causes further distress selling and a collapse in prices. So the dollar falls in value, but therefore the debts actually rise in effective value. So companies that have debts become further technically bankrupt. And when they go bankrupt, their profits are going to fall. Well, they fall in profits as well as bankruptcies. And therefore they're going to reduce output, reduce trade, sack workers. So pessimism will rise. And given all that, you're going to hoard. So the circulation of money's contracted and its rate of circulation will fall as well. And you're also going to get complicated changes in the rate of interest because with falling prices, you're going to get falling nominal rates of interest, but the effective rate can be expanded by the level of deflation. So even though nominal rates fell to 2 and 3% for loans during 1931 and 32, the rate of deflation was over 10%. So the real rate of interest was effectively 15%, which of course is crushing, even in normal times. So it's a non-equilibrium theory, and it gives, they said, a beautiful statement of why you have to think in non-equilibrium to do economics. He said we might assume, and I've shown you this one yesterday, we might assume that all forces tend towards a stable equilibrium. And if that's the case, then any disturbances will get smaller and smaller as you converge towards that equilibrium. But he said the exact equilibrium is seldom reached and never long maintained. And because new disturbances are bound to turn up, and therefore a variable will always be above or below what you might define as its equilibrium value. So therefore there must be over or under production, over or under consumption, over or under everything else. He said it is absurd to assume for any long period of time that the variables in the economy will be in equilibrium as it is to assume that the Atlantic Ocean will be without a wave. So it's just showing how fallacious it is to think in equilibrium terms. And that's why I think he's done far better than the leading neoclassical today, because Krugman is still hanging on to that equilibrium thinking aggressively, okay, defending against any non-equilibrium thinking. We should have gone with Fisher and non-equilibrium 70 years ago. And that's one reason I fight so vigorously for saying we have to have a non-equilibrium approach to economics, even if I might like a lot of the conclusions that people like Krugman reach using equilibrium thinking. Now, given this vision, Fisher could explain two types of events. Ordinary cycles, where you have deflation or excessive debt, but not both. And the 1970s are a classic instance of that. We had extremely high levels of debt at the time. We have higher debt now. People being forced into debt liquidations, but an inflation rate of 15%. And that meant that over time, that inflation reduced the debt burden. But depressions are where you get both at the same time. And he said, well, you get cycles when one occurs but not the other. And he said ultimately it's a bit like a stable equilibrium. The ship rocks and then it returns to a resting point. But a Great Depression is where you get both at the same time, over-indebtedness and deflation. He said the more debtors pay, the more they owe. I call this Fisher's paradox. Because you're paying down debt, reducing money in circulation, you're driving prices down, the real debt burden actually rises. And that happened quite dramatically in the 1930s. I'll show you some graphs on that tomorrow. So that's Fisher. Now most people focus upon Keynes. I call myself a post-Keynesian economist. And it makes Keynes and being based on Keynes seen as an essential part of being a non-orthodox economist. I actually think Keynes has got negatives and positives. I think we would learn more from Fisher about the Great Depression than we learned from Keynes. Of course, Keynes made crucial contributions about the role of uncertainty and expectations in capitalism, but he also offered an equilibrium theory of finance without banks. And in the preface of the general theory, he says, while we find that money enters into the economic scheme in an essential way, technical monetary details fall into the background. There was no discussion of the role of banks and lending in the general theory. And in fact, what he thought he was doing with the general theory is reintegrating the theory of money back into what he called our fundamental theory of value, supply and demand. And that's largely a loanable funds vision of money, which I'll be contradicting in the final lecture. So his contribution on that front was negative to disequilibrium thinking. His key non-equilibrium work are in chapters 12 and 17 of the general theory and the papers he wrote in 1937. And my feeling, if you want to get a good vision, a useful vision of Keynes from this point of view, I'd read the 1937 papers only. The general theory I find far too messy a work, a mixture of disequilibrium and equilibrium thinking, leaving out money, which others can argue is essential, I certainly do, and only 2 chapters that I think are really fantastic. But let's look at the good parts that Keynes contributed here. And if you read the general theory, you'll normally see him talking about how investment is driven by looking at the relationship between a marginal, very neoclassical concept, marginal efficiency of investment and rate of interest. But in chapter 17, he starts saying that there are 2 price levels. There's a cost price level for commodities and a speculative level for assets. And he said investment is motivated by the desire to produce those assets of which the normal supply price is less than the demand price. Now that is a very hard concept to explain from the neoclassical point of view. Of course, it's quite straightforward from the Marxian point of view I showed you earlier. But he said demand price for assets and capital goods was determined by prospective yields. Okay? What you thought you would get out of the machinery is the price you were willing to pay, or the shares. Whereas the supply price was the cost of production. Now this fits in with Marx's logic, not with Marshallian logic. So there are elements where Keynes is combining various different theories in a very confusing way. But after the general theory, this 2 price level analysis is much more dominant. He doesn't talk in Marshallian terms at all after that. So talking in 1937, he says the scale of production of capital assets depends, and I love this phrase, of course. In other words, it's obvious to him now. Okay? Whenever anything becomes obvious to Keynes, when he hadn't realised it beforehand, he uses the phrase of course. Okay? Depends, of course, on the relation between the cost of production and the prices they're expected to realise in the market. So he's seeing 2 price levels: cost of production, sale price of capital assets. And when he looked back at his previous analysis, the marginal efficiency of investment, he said this actually implies you can hypothesise what the future is going to be by reducing the future to certainty using random chance, the Benthamite calculus. But he said, in fact, what we know about the future can't be reduced to probability. We simply do not know. So uncertainty is an essential part of his thinking here. So he said, how do you form expectations about the future if you can't use probability? He said, well, they're going to be fragile. Whatever expectations you have are not going to be held rigidly because you simply can't know the future. But those expectations will then affect what you pay for share prices, and therefore those prices will be subject to sudden and violent change. And that will also therefore affect the level of investment. So investment is going to be very volatile. So the marginal efficiency of capital would only make sense if you could actually have a sensible value for the denominator, the price you put on capital, versus the return you expect to get, which goes in the numerator. But if you have an incredibly volatile basis for putting that valuation in the denominator, you're not going to be able to work out a ratio at all. The whole idea of a marginal efficiency in investment presumes a knowable future. So he starts to reject that entire idea. And he said, then, how do we actually form expectations? We said there are three conventions. First of all, we assume that the present is a much more serviceable guide to the future than a candid examination of past experience would show that it has been in the past. We just project forward current conditions because we can't know the future, so we extrapolate forward what's happening now. We accept that existing opinion is well informed, so we fall back on what others believe. We accept what others, we go with the herd effectively. And that's the classic statement of the herd. We rely upon mass sentiment. We endeavour to fall back on the judgment of the rest of the world, which is perhaps better informed. Now that gives you an incredibly fragile basis for setting a price of capital assets. So Keynes is augmenting Fisher. He explains the concept. Fisher explains what happens when you get into too much debt. Keynes in some ways explains how you can get there. Overblown expectations will lead to you borrowing more money during a boom than is actually justified. The clump comes along, you have to liquidate. So that's the explanation. That's Keynes's contribution in Disequilibrium. The next person I'm going to talk about is Kalecki. I'm actually running badly over time here, I've just realised. So I'm going to stop with this point on Kalecki, and I'll transfer that to tomorrow's lecture. So I'm sorry for dumping too much on you in one day. I thought I might hit this point. Let's leave it there, and much more cappuccino tomorrow morning.